Congratulations. We made it to our last element of Module 11 that we want to talk about, some of the ratios. There's only a couple we needed to be aware of, and that we'll be analyzing and using. Well, let's take a look, and we'll start. I've got 3 slides that you will see, so hopefully not too complex, not too much to worry about. So we have operating cash flow to current liabilities. So the stuff we owe, can our operations cover it, is what the question we're asking. How and to what degree? So the ability to liquidate current liabilities with our cash flow from operations. And it's just a basic calculation, cash flow from operating activities. That is, again, for a period of time. That's cash flow for the whole year. That's why we have the denominator taking an average of the balance sheet items. So average current liabilities. That's the operating cash flow from current liabilities. Starbucks calculated to 2.41. In 2018, the average for the Standard & Poor's 500, the S&P 500, was 0.5. So you're saying, okay, so they couldn't really cover with current operations their current liability obligations. But that's always below 1. But Starbucks is in pretty good shape, and they're a cash-based business anyways. And that actually does make a difference and does reflect on those kind of businesses. So we also look at operating cash flow to capital expenditures. So instead of having what we just had, we just came from the average current liabilities in the denominator. We put capital expenditures in the denominator. And that's basically our replacement value. What's the ability to replace and or expand our property, plant, and equipment based on our operating cash flows? Okay. So how much did we spend over the year? Again, this is a capital expenditures, a period of time. Cash flow from operations are also a period of time. And a ratio greater than 1 means the company operations, yeah, we can cover it. We're generating enough cash to provide the level of fixed asset growth. And that is a sign of strength as well. And the final one is free cash flow. There are a couple of ways that gets calculated. We're going to emphasize the one on the right, that's as defined in the text as it states there. But free cash flow is a metric. It's fairly commonly used by analysts to value companies. And the definition, when we have net operating profit after tax, we know NOPAT, minus increase in net operating assets, NOA. So the net profit, operating profit, minus the change in operating assets, the increase, that's what we have as a surplus or free cash flow or excess. It's maybe the best way to think about it. So expressing free cash flow in terms of NOPAT and NOA, 2 specific means to increase firm value: increase the NOPAT or control the expenditures on the assets, the growth of those net operating assets that are in our that we're in control of. So that's what we're looking at for free cash flow. And free cash flow is pretty useful to be aware of for analysts, and it's something we want to make sure we have a handle on and understand the nature of free cash flow. That concludes Module 11. I'm sure you will enjoy the assignments and get a better feel. Cash flow is powerful. Cash flow is crucial to success, which is why we spend a whole chapter specifically analyzing cash flow in the framework of operating, investing, and financing. Thank you for your time, and we'll look forward to our next encounter. Take care.